Good afternoon and welcome to HYCM's online trading workshop with myself, Giles Coughlin. For the next hour, I'm going to be taking you through some of the latest market events and trying to put into context where we are at the moment with the FX market, as well as sharing, a number of sort of tips in general trading and some comment on our particular market situation we're in. And the market has been a lot more volatile recently, so as FX traders, these are potentially more interesting times for us. I'm just going to say hello to folks as they come in. Hi, Dan, Mohammed, Ram, Robert, good to have you. Sammy, Van, Yao, good to have you guys on board. Looking forward to the session. Don't forget, as we go through the webinar, there is a question panel on the GoToWebinar control panel, which you have. So feel free to type in questions as we go along, and I will either answer the questions as we go along, or if not, I'll have a quick look towards the end of the webinar and make sure we cover them. So any specific questions that come up, please do make sure you pop them in there. And just going to go through the disclaimer, which I have to go through each week. And this is just to make it clear that the whole idea of this workshop is it's designed to show you guys how I, as a professional trader, go about making decisions in the FX markets. It's not a signal service as such. So even though we're looking at different currency pairs, potentially different entries and exits and etc., it's not designed to be a signal service where you copy the signals. Instead, it's designed to be education, so you can see how I, as a professional trader, go about trading. And you can see the thinking process, the idea to help you guys make better and more informed decisions for your trading. So that's just to make that clear. And as I've said before, it makes sense, doesn't it? Because market conditions change so quickly as well. If you're not tuned into those market narratives, then you're not going to understand a change. So with the session ahead, what we'll be looking at is we're going to be looking at kind of how to go about understanding the market mood each time you come to a session. The FX trading day, as we know, is split up into 3 key sessions. Starts off with the Asian session, moves into the European, and then closes the day on the North American session. So what we want to do is that as we come to our desks at different points during that session, we want to know what the market mood is. And once we establish the market mood, we want to know how do we go about using that knowledge to actually make a trade. So that's the framework that I follow each time. There's a special topic we're going to be looking at. We're looking at a potential divergence that's setting up between the Australian and New Zealand Central Bank. Now this is an early divergence that's potentially in place. So this is just something I want to flag up to you guys because it's something that's caught my interest. And it's a trade that I'm in at the moment, and I'm looking for more upside for the Australian New Zealand dollar currency pair. So I was going to outline, my thinking behind that, my reasons, and what's going to make me, have more confidence in that, what might make me pull that trade. Because it's kind of a trade that's, developing. I'll make that clear as we go through at the end of the session. Handout for the session. If you go to the GoToWebinar control panel, you should see a handout section. I hope you can all hear me okay. I'm assuming that everyone can hear me all right. I haven't done my usual, which is just check everyone can hear me. So I hope that's okay. Any issues, please just let me know, but it seems to be okay my end. Yeah, I think someone would have said they couldn't hear me by now. The handout for the session is the workshop guide. So if you click on that workshop guide, you should have the workshop that comes up here. Now, apologies, we're looking at a different special topic today. That was a special topic we looked back from the 30th of July. So don't worry, we will be looking at something different, which is the RBA, RBNZ central bank divergence. But this kind of principle, particularly if you just joined me for the first time today, if you see the way I've divided the printout into 5 main headings, which is looking back, looking forward, looking at the charts, looking at risk, and looking at the outcome of your trade, these are the 5 principles on which I am basing my trading on every single day. This has become second nature to me, and I just systematically work through these 5 topics each and every morning when I'm coming to my desk and throughout the day. So what I'm going to be doing is just going through how I go through that, how I'm looking at recent sentiment and market mood, and then trying to identify that key sentiment. I mean, you know, the key thing to understanding with FX trading is it's all about context. It's all about the context of everything happening, because when you understand the context, you start to understand why currencies will move at certain times and not others. When you understand the context, you understand this is why this data point has a lot of significance today, but had less significance last week. You know, a very obvious example for us at the moment is Brexit. Okay, we know with Brexit news, the concern is that Britain leaves the European Union without no deal. And in terms of trading the pound, that overriding concern of Brexit and a no-deal Brexit means that the pound is constantly being sold. So that tells us that the pound is not being moved around by the economic data in the way that it normally would, because the no-deal Brexit concern is the main issue. Now, the way we deal with that as currency traders is we're looking for an economic data point that goes in line with that sentiment, with that negative bearish sentiment. And that's what we saw at the end of last week. We saw some GDP data that came out negatively for the UK. And when we saw that negative GDP data came out, it was concerned that Brexit is weighing on Britain. And so we saw a sudden sell-off in the pound. It was a very simple trade. We'll maybe look at that later on in the day, and I'll show you that was a trade I actually took at the end of last week, and that might serve as a good illustration for it. So that's the handout. Make sure you've got that there. Make sure that's all in your line.
On the EMFX one,
oh, sorry,
those following the Argentine peso has opened for 3% weaker.
The man's always speaking when I don't want him to, so I just
US dollar, as according to
turn
traders.
that off. Now, there we go. So apologies for that. If you've got any suggestions for trades, ideas, or maybe you've got a suggestion for a topic you'd like covered, please email me here. This email comes straight through to me, and I can reply to you and let you know if we can cover a topic. So that's absolutely fine. So this is the big picture of what we're looking at. We're going to be looking at strong, weak currencies for the European session, and we'll look at strong, weak currencies for the American session going forward. Okay, those two things are what we're covering. So we'll look at it twice. So the idea is we learn more by looking at things twice rather than just looking at one sentiment session. Turn to your handout. This will be the basis on which we start our course on, looking at recent sentiment, identifying key market sentiment, and summarizing that sentiment in a sentence or two. The whole point of the first step of looking back is to try to really see what is currently driving the market at the moment. You know, one of the things that FX traders and the markets as general really thrive on is a freshness of news. Okay, and oh, hang on. Yeah, okay, good question. Why the bad German news didn't affect the euro. Now, Sammy, this is a really good point. We had some negative German ZU data that came out this morning. I think it was minus 44 as opposed to a minus 28 expected. The figures were roughly like that. And the market didn't respond badly to that data. Now, I think there's a couple of reasons, Sammy. I'll just show you for the other guys who are not tuned into this. I'll just show you what the data point was. Okay. Now, so this was the data here. So we had the CPI data out for Germany, and then we had the German ZU economic data. Now, I was looking at this data as it's coming out. That's a very poor reading. and I was watching the euro, and I was thinking, is the euro going to sell off on this poor data? Now the euro sort of a little bit, but then recovered. It didn't really make much of a dent in the euro at all. So what that's telling me, Sammy, is telling me that the market is getting, tired and used to the fact that we're seeing poor economic sentiment, poor industrial growth, poor eurozone growth out of Germany, and the market's got a little bit tired of that. So what it's telling me is that is a narrative that the market's got used to. And the other thing is the main kind of focus is likely to be the flash GDP. So there was always two events this week. There was the German's view economic sentiment, and then we have the flash GDP out on 10 a.m. British Summer Time tomorrow, and we have the it's early as well in the day, isn't it? Yeah, we have the preliminary GDP out of Germany at 7 a.m. British Summer Time. So those two events, there's the euro will be vulnerable. So if we get that really poor GDP, so we get a very poor GDP, reading, expecting that to weigh heavily on the euro tomorrow, because the sentiment is negative for the euro, with the ECB expected to cut interest rates in September. So, Sammy, all I can suggest is that the market is starting to get a bit tired of that poor data, which leads into my point I was saying, really, which is that the market's looking for fresh news, okay? Something that's new, and that tends to be the best opportunities we're going to get as FX traders. So as we're looking back, let's start running through how this looks. The first thing to look back is the Asian session, and there was some holidays for Asia on Monday. Those have closed, and as the Asian equity markets sprung to life, they followed the Wall Street losses from yesterday on the general concern over global growth and continued disruption in Hong Kong amidst the growing fears of Chinese intervention. So what we saw is the Nikkei down a full percentage point. As I've said, take notice of the indexes when the equity markets are down a full percentage point. That's really when you want to pay attention, when you're getting that full percentage point change. We had the Hang Seng down a full 2%. Nikkei futures at the time of taking this was 0.25%. They are currently down 5.9%. So risk sentiment has got worse since I took this screenshot. The Shanghai index was down 0.63%. So what this tells us again is, the equity markets. Each time I come to my desk, I take a look at the equity markets, and I come to my desk at the start of the European session, end of the Asian session. So I'll quickly look at the Asian markets, and that gives me an indication of what the appetite for risk is like. So you want to get into the habit of this yourself, and what you want to see is that a falling equity market is a risk-off environment. So when you see the equity markets down, we're heading into a risk-off environment. The equity market is very sensitive to risk. And when investors are concerned, they will take money out of the equity market and they will put it into the bond market. There is a school of thought that says you should be holding either equities or bonds in your portfolio. So that's why investors rotate out of equities and into bonds during time of risk. And of course, like a bond offers a more secure investment, generally speaking, doesn't it? Because if you've got a high grade bond and you've got a guaranteed yield, it means you can put your money into a bond, you'll get your 2% yield at the end of the year. So your cash is safe and you've got 2% yield on that bond. So you can see that's more attractive. With an equity, you're buying either a company or you're buying the indices, and you're more vulnerable to the price movement of that index. And in a risk-off environment, you don't want to be risking your capital. Okay, so it makes sense. So that's just a learning point there. When you see the falling equity market, it tells you the market is in a risk-off mode. And the risk-off mode, if you were to type in what do you typically expect, guys, when the market is in a risk-off mode, which currencies do you expect to see strong? If you want to just type that in the question panel, just see if you're with me. What currencies would we expect to be strong in a risk-off mode? That's it, Sammy, exactly right. Swiss franc and Japanese yen. Yeah, well done. Yeah, so that's what we'd expect. So that tells me as soon as I come to my desk, I'm expecting, I'm expecting to see Japanese yen strength. And that's exactly what we've been seeing over the last few days, because these concerns over global growth, look at all the concerns there are at the moment. There's a global growth concern. There's the US-China trade dispute. There is political uncertainty out of Italy. There is Brexit concerns. There are so many different issues that the yen and the Swiss franc are constantly being bid. And so the focus is moving away from the Japanese yen and the Swiss franc's economy, Swiss's economy, and it's just that these currencies are being bought as risk-off plays. And the reason is Japanese yen, the way Japanese have structured their debt, is it's seen as a very secure country to put your money in, because the debt is literally shared amongst all the inhabitants. So what that means is that investors are very confident that Japanese yen will keep its value and it's not going to default. And the strength of the Japanese yen in a crisis is a very well established market principle. Even in the Second World War, when a nuclear bomb was dropped on Japan, the Japanese yen appreciated. So that gives you some sense of how a safe haven it's seen. And just to see that global growth, you can see China and the US with their trade dispute between the two countries, nearly 40% of the world's GDP is made up of China and US's economy. So when these two economies are not harmonious, and they haven't worked out a trade agreement and they're putting tariffs on each other, it's clear that fallout is going to drag on the whole world. That's why in December 2018 we've seen this, constant return to the risk-off theme. We've seen constant rotations, out of the equity markets on this, fear that global growth. That's obviously bonds absolutely soaring and yields tumbling. So that's what's going on. That's the thinking. So, okay, come to the desk this morning and you can see, okay, this same narrative is playing out. Okay, got exactly the same narrative playing out. We're going into a risk-off mode. You just see, look, here's the stock markets. You can see the market, risk aversion the last sort of 4 or 5 days. 1, 2, 3, 4, 5. You can see sudden. So this was actually from last week. We saw that. This was from last week. We saw the days, the risk coming off. We had a slight rebound of the 200 exponential moving average. This is the same chart, the S&P 500. But you can see that rebound, it bounced off the 200, found some support off the 100, and then has rotated back down across the 100. But you can see from the top, it's a strong and heavy fall. 1, 2, 3, 4. A large, sudden, volatile decline. That trend line's been broken. You can see, look, risk aversion is very clearly in the market. Okay. Also, we had overnight that I was paying attention to was the Reserve Bank of Australia's Assistant Governor, Kent, was speaking, and he sort of said about Australia that lower rates are helping financial conditions in the usual way, and that the recent easing is supporting demand. And he was saying, look, the Reserve Bank of Australia is not targeting unemployment rate with policy, but he said it's unlikely that the RBA are going to need negative rates. Okay, so Australian business confidence also moved up +4 index points last night, showing a broad-based lift among industries. And we'll be looking later at the RBNZ, on the other hand, who remain more dovish than the RBA. So there was a a little bit of optimism from the RBA's assistant governor, and we have more speeches from the RBA out this week. There was a report as well that the UK Prime Minister Boris Johnson's reported to believe the EU will cave in and save Ireland from a no-deal Brexit. So we had this report here. That's what PM Boris Johnson is expecting, and that really just indicates that Boris Johnson is firmly committed to a no-deal Brexit. He is on, quote, as saying that 31st of October is do or die. So he has really made his place very clear. He's absolutely committed to bringing Britain out of the European Union, even if that means a no deal. So these ongoing Brexit concerns are key, and there's a whole load of issues around this. Like there's some ministers at the moment trying to stop Boris Johnson from inflicting a no deal on the country, trying to force him to extend Article 50. And if these kind of issues can happen, they're all going to move the pound. So if there is a statement that comes out that says that some Labour opposition MPs are going to find a way or have found a way to prevent Boris Johnson leaving the European Union on the 31st of October, then you'd expect a sudden rally in the pound. So that's just something to be, really, really aware of going forward. So as we look at the Asian session, we're looking for a weak currency and a strong currency. So as I came to my desk this morning, looking at, all the terminals, the conclusion for me was the weak currency is the pound and the strong currency is the Japanese yen. Okay, that was the pairing that made sense. And at the time when I came to my desk, there was some key data ahead, which was for the UK, and there was the German's view and the CPI data. Now, the interesting setup that I was potentially looking at was, and here's the data here, I'll just explain this to you. It was the average earnings data out of the UK. Now, earnings have been really quite good in the UK, and this latest reading was good as well. Okay, now one of the reasons earnings have been good in the UK is because with Britain leaving the European Union, some European workers have left the UK early in anticipation of Britain leaving the UK. So as a result, there is, particularly in the hospitality sector, there is a lot of opportunity, a lot of job opportunities have opened up. So it means there's increased demand. So it means people can, are being offered more wages in order to attract people into those positions. So, part of the reason that is why wages are holding up. There's also some other demographic reasons as age of people change and people move from different sectors. But what I was looking at here is, if Brexit starts to weigh on average earnings, if those issues start to affect the pound's earnings and unemployment rate and things like that, then that's going to be very negative for the pound. So let me just move this away. Let me bring in, there we go, bring in a pound yen chart. Okay. So, once we've sort of analysed the sentiment, what we really want to do is we really want to look at the chart. So let's just take that down. So now, see, what you can see is when the data came out this morning, it obviously came out stronger. And so we had a little uptick in the pound. But what I was looking for a bad, a bad reading. And a bad reading would have sent the pound down because the sentiment for the pound was negative. And not only was the sentiment negative for the pound, But also, if the data point was bad, you would have the data point and the sentiment matching. So in that scenario, see, so here's the data point. The data point here is the average earnings. If that data point was negative, then we know the pound is being sold on Brexit concerns. All of a sudden, the data and the sentiment is matching, and so you're going to get a stronger move. Okay, so we knew that the yen is being bought on the risk-off sentiment. You see, look, the reason I didn't want to just jump in is look how far this pair's come down. It's come down from 136 in the middle of July, roughly, down to 126 roughly. You know, so you're looking, you know, over 900 points, getting on towards 1,000 points of movement. So, you know, markets don't move in a straight line. So you've got to ask yourself in this situation, what is there extra to push this down? You don't want to just jump in the market here. Instead, you want to think, what is it extra, or where, you know, where would be a sensible place to enter? Now, just using basic support and resistance, you know, one sensible place to have entered would have been up here at the 1.28 level here, okay? And you've got the big round number, 1.28. You've got this support turned resistance level here. Obviously, I like to use pivot points. And you've got a pivot point here. You've got the pivot point here on the 1 hour chart. So looking at all together, and the 100 exponential moving average. So as I'm looking at that, you know, for me, there is, you know, one key place here to enter. Just one obvious place. So let's just go to the 15-minute. Okay, and so you would have, you know, you're marking on your chart, potentially put your orders in, you wanting to sell from here, the 128 level, okay? And then you're playing back down to either the first pivot point or the second pivot point. You can see how the trade goes, but then you just want to bank your pips, because, you know, any movement from this point, any movement up is going to be, you know, could be profit taking, as long as it's not based on some other news, as long as it's not based on positive news. Yeah, pound US dollar. Now, the thing with the pound US dollar is you had the CPI data coming out for the US. So if you look at you've got the CPI data coming out here, and you know that has a strong potential for moving the US dollar. Now, with the US dollar, Hashi, you know, it's a very interesting place, because the US dollar has been quite weak recently, and it's because there's growing expectation for the Federal Reserve to be more dovish. They're wanting the Federal Reserve to be cutting interest rates. I think at the moment, I think yesterday there was about a 25% chance that the Federal Reserve was seen as cutting interest rates by 50 basis points next month. And that just doesn't make sense to me, because the US economy has been really strong. The only way it makes sense, I think, is with President Trump tweeting how he wants the Federal Reserve to lower interest rates. I suppose the market is thinking that the Federal Reserve is going to buckle to President Trump pressure, and the Federal Reserve will, you know, eventually go in line with what President Trump wants. So the reason I didn't want to trade a pound US dollar pair is for that reason. You've got the CPI data coming out at 130, so it makes much more sense. I know that the yen, you see, is a strong currency. I know that the yen is strong, so I really wanted to pair the pound yen to try to find a fresh trigger to go short. Now, I didn't find that fresh trigger, but that's what I was wanting to find. Okay, I hope that helps, Ashik. So then we had the German CPI final, that was flat as expected. And then we had the German ZEW economic sentiment data out in the European session. Yeah, it's 44.1 versus 28.5. So, a really poor deterioration on the outlook for the German economy. There's a lot of big issues going on with Europe at the moment. And don't forget that Brexit will impact the, you're welcome, Hashik. Don't forget that Brexit will impact the European Union as well. There's a lot of focus how Brexit is going to impact the UK. But don't forget that if there's a no-deal Brexit, think of the manufacturing that goes on in Germany that comes to the UK. Think of all the German cars, Audi, BMW, Mercedes. These are very popular cars here in the UK. And if there's a no-deal, Brexit, German manufacturing is going to suffer. You think there's a lot of flowers that come over from Holland, and with the pound weakening, I know I was reading a report the other day that some Dutch exporters is making it very hard for them to export flowers to the UK now with the exchange rate so bad. It's just really not very profitable for them. So Europe is going to be hit with a no-deal Brexit as well. So that's playing in, as well as the fact that Europe trades with China. So you're getting hit from less orders coming from Asia as well in Europe. So they're getting hit kind of both ways. So I think the focus for me is the second quarter GDP. And I'll be looking at that to see if we get a bad second quarter GDP data out for Germany, and then if we get a flash GDP data out for the EU tomorrow, that will be potentially a fresh trigger for a short on the euro. And don't forget, you've got the Italian political situation that's bubbling away in the background as well. So there is risks for the downside on the euro, and I really wanted to be trading a euro US dollar short, and I've given up trying to do that. I had it, and price was just hanging around that 1.1250 level on the euro US dollar pair. But in the end, the US dollar it wasn't the strength that I wanted to see. That just wasn't there. And that's when you got to just tune in with what the market is thinking, and the market is thinking that the Federal Reserve is going to be moving to that dovish side. But obviously the CPI data that was out today, that was what the CPI data out, the core CPI, the Fed's preferred method. Now that was excellent, 0.3% versus 0.2%. So that shows that the US economy is holding up. So data points like that, as they keep coming in, are going to make strength for the US dollar. So that's why at the moment we're seeing some US dollar strength. And I took a quick US dollar CAD long on the back of that, with the oil markets down. They're down 0.71%. Slightly more optimistic, CPI data out of the US. Then I know that CAD is going to be relatively weak with the oil prices under pressure. I know that US is going to have a little bit more strength. So I'm nothing glamorous. I'm just going for a very short trade, looking for a take profit around the 1.33080 region. Okay, looking back, so European more mid-session. Look, we had European equities low. See that FTSE down, Euro stocks down, French 40, German index down, Spanish ABEX, Portuguese, Italian FTSE, the Athenian composite, all like down. Okay, so risk off sentiment, bond yields falling as well. That all the German bonds, all those fall in yield. So it tells me, look, this is a poor risk environment. What was very interesting as well here we had the first corporate bond issued at negative interest rate. Mohammed, I'll go through some of these for you in a minute, Mohammed. Okay, some of these slides. Just hang on a minute, and we'll look at that. We'll look at that in a few slides' time. Okay. Nestle, the manufacturer of chocolate and spreads and all sorts of food products, they've issued a negative interest rate on a 10-year bond, so minus 0.01%, I think, if I've got that right. So basically, it will now cost you money to lend Nestle money. Can you imagine that? So you're actually having to pay to lend money. So that tells you that investors are very, very, very concerned about how to preserve capital. So this is seen as such a potentially volatile market condition that bonds are now going into negative interest rates. They have been for sovereign bonds for a while, but this is the first corporate bond that's now negative interest rates. So literally, it will cost you money to lend money. It's hard to imagine, isn't it? But what's the implications of negative yielding bonds? Well, one of the implications of negative yielding bonds is quite obvious when you think about it, because if you're an investor, is it that attractive to put your money into it? Do you really want to spend money to lend it so you will earn less money in a year? No, you really don't. Okay, so where do you put your investments? Well, there's a couple of places, isn't there? You could put your investments in riskier bonds. Now, the riskier a bond is, the more yield or coupon it offers. And this makes sense, doesn't it? Look, because if someone is a risky person to lend money to, you'd obviously want more reward for lending to them, wouldn't you? Because you're thinking, well, this person might default on the loan. So to offset the risk of default, you have a higher reward. So one of the things is investors will be, tempted to invest in lower grade bonds, okay? Bonds that offer higher yields. That's one implication. The other implication is something we've been seeing for a while now, and it's something I've been talking about for a while. We'll just move over here. And that is the movement of gold. So I'll just pull up a gold chart for us. Oh, hang on, that's it. Right, here we go. So the gold chart, see, gold has been on a tear for quite a few weeks. Look, you can see basically since December 2018, gold has just been on this uptrend. Okay, let's get rid of the pivot point for us. Okay, now it was here 1350 when I was taking a course in Dubai, and we were looking at the path of gold, and it was obvious that the path of gold was going to depend very, very simply. Oh, hang on. The path of gold was going to depend very, very simply on one issue, and the issue was going to be here at 1350 was the Federal Reserve going to become more dovish? Were they going to start cutting interest rates? And if they did cut interest rates, there was going to be this overflow into the world central banks of negative interest rates. Okay, that's what happened, and they were more dovish, and gold broke out. Now we're having gold continuing this breakout. There's still more concern about a dovish Fed, so that's why we're seeing gold being bought. So gold is breaking out of some very key levels here. Okay, you can see this level here, the 1400 level, breaking out of there, and there's a lot of space up there heading up to remember those highs in 2011 and 12 when market was really big. Look, we're heading back up towards those highs. That's potentially where it goes, and the longer this negative yielding environment works, the more likely that's going to be the situation. So one of the implications of these negative yields, okay, we've got there's some further US-China talks are planned in the next 2 weeks. Okay, yeah, okay, so that's just interesting. There's meant to be some further US-China talks planned in the next 2 weeks. Just seeing quite a bit of downside in the US dollar. Yeah, so we're seeing some reaction in the markets. I just saw that on my terminal. I just wanted to see what that is. Yeah, so safe havens are sold off. Equities and crude have seen positive sticks. So that's like a really good learning point here. Okay, so the concerns, you know, a lot of the global concerns have been about global growth, US-China trade talks. So all of a sudden, it's been confirmed that Chinese Vice Premier Liu has spoken with US Secretary Lighthizer and Treasury Secretary Mnuchin, and further US-China talks are now planned in the next 2 weeks. Okay, so that's been confirmed. So that's why we saw some haven sell-off. So let's just look at the US dollar Japanese yen pair. Let's just see what happened there. So you can see here, we're seeing some of that yen strength has been immediately reversed, okay? And that's what you'd expect, because yen is being bid as a safe haven, and as soon as you get some positive risk news, the yen is no longer being bid. So, you know, that's a kind of situation where you can potentially make pips if you're around and you're there when those kind of news just come out. So equities and crude have seen positive ticks. So let's look at the crude market. The crude market, yeah, is now, you know, it was down 0.82%. It's now up flat, and we're seeing the S&P 500 up 0.3 plus 0.34% now and climbing. Okay, so that's what's happening. That's the interplay between these kind of markets. When you get risk is on, you're seeing yen being bid, equity selling off, and now we've got this, you know, positive news for risk sentiment. You've got safe havens are sold off, equities and crude is seeing some positive ticks. So that's just a little just worth mentioning. It's worth explaining some of these things as they happen real time. And so you can see, you know, but that, you know, going back to this, the implication of negative yielding bonds is investors are looking for other places to park their money. Gold offers one potential place, and that's why gold has appeal at the moment. So sentiment for the European session, you know, just the importance of waiting for a fresh driver. You know, sometimes when markets have been heavily sold off, or you come to the desk and there's anything particularly new, you want to wait for that fresh driver. What is fresh? What is going to move it? And what's going to move the currency in the direction of the sentiment? You know, that's when you can really get some really good opportunities. You either wait for a stronger pullback, or you wait for a fresh driver. And, you know, a driver in the market, we've just seen a driver in the market there with dollar yen, and we can see that that's, you know, that's positive. You know, for risk trades. So we know what would we expect to see if we're on a risk on environment. We'd expect to see Australian dollar, New Zealand dollar strength, for instance. So yeah, let's just see. Yeah. So let's just go back. Let's just see. We expect to see some Australian dollar strength against the yen. This is a very sensitive risk pair to risk, and so just going down to the 5-minute chart, you can see that sudden bullish candle. I mean, these are not huge moves. It's about 30 points, but you know, it's just worth seeing that you know, real time. So looking at the charts, we've looked at the pound yen. Let's look at the COT report. This is just helpful. Comes out each Friday, and it just lets market participants know where the large hedge funds, where the big investors are positioning. We've got on the euro, we've got 44,000 contracts short. Pound short is massive. It's been the largest pound short since 2017, 102,000 contracts short. So that tells you something. Obviously, the pound is being heavily sold, but it also tells you if this news changes. So say, for example, you know, Boris Johnson and EU's President Juncker get together and they say, don't worry, we've managed to stop a no-deal Brexit, and we've worked out a relationship going forward, which you think is going to be work well for both the EU and Britain. Then you expect the pound to rally hugely, because all those short positions will be unwound, people will be unwinding them and closing them, and they'll be taking profit on their shorts, and stocks will be getting hit, and that'll just drive the price higher, okay? And that fundamental news will change things. So that's the kind of event to be looking at. That event can potentially be very, very good. So be aware of a change in the pound sentiment. We also have a lot of Australian dollar shorts. The second largest short position is the Australian dollar. So that's looking quite, heavily done now, those Australian dollar shorts. And I did come across an interesting graph. Here it is. I'll just click this up. Yeah, there it is. And just saying here that I was coming across a Bloomberg article, and you can see there's a slight divergence now. This is Australia's leading indicator, the OECD, which kind of gives an indication of how the Australian economy is doing. And this is the Australian dollar trade weighted index. So normally, you can see these two work in tandem. When the Australian leading indicator is positive, you tend to get a positive movement in the Australian dollar. Okay, there's a general correlation, and where they do diverge, eventually they're coming back into synchronization. And so here you can see a divergence there. And we've currently got a divergence here. We've got the price of Australian dollar falling, but we've got the leading indicator, the OECD leading indicator, indicating that things are a bit better in the Australian economy. So that's now this is how we use it. We're thinking, okay, well, there's a lot of traders short. It's the second largest short position. So if we start seeing some positive data out for the Reserve Bank of Australia, and Thursday, we've got key employment data out. So I'll just show you that on Thursday. Right, we've got the context here. We can see, look, Thursday, Australian dollar, the wage price. I'm looking for the employment data. Maybe I got this. Here we go. Here we go. Oops, a daisy. Just get rid of that for a second. Oh, sorry about that. I just got rid of the whole thing. All right. Here it is, Thursday. Got the employment and unemployment rate here. Okay, very important. Wage, labour market, the RBA said are very important for them. So if we get a good uptick in the employment change, the employment rate, that will be, contradicting some of that, very short Australian dollar position. So again, that's one trade I'm looking at there. Conversely, if it's a very bad data point, then we'll be looking at that, confirming those short positions. So that's just something to look out for towards the end of the week. Okay, free resources to work out sentiment by yourself. Mohammed, this is some of these are for you. You will find lots of different resources on all these different websites. Please just, take a screenshot of them. Also, TeleTrader has some good access to equity markets as well. So you've got TeleTrader, and you've got, NASDAQ, S&P 500. Look, it's up now 1.54%. US crude is up now 3%. Here's crude look, it's up nearly 3% here on this terminal. I've got it on my Bloomberg terminal. I've got it up plus 3%, 56.60. Don't know why that's showing a different figure here, but I go with the. Okay, let me just check this, how reliable this is. Yeah, S&P 500 1.4. Yeah, that's corresponding. FTSE 100. It's up 0.42%. Yeah, some of this actually isn't corresponding to my Bloomberg terminal. I'm not sure. Okay, I've got some question marks here, Mohammed. I had thought this was good. I've got some question marks here over the prices, and if I just show you, see, I'll just show you the difference. So you see here, you know, I've got the S&P. This is from the Bloomberg terminal. Got the S&P 500 up 1.29%, 500 futures up 0.56%. Got the FTSE 100 still down 0.60%, but they've got the FTSE up 0.31%. So okay, I got some question marks about that. Sorry about that, Mohammed. That was a site which I had thought would be pretty reliable. I'll take that off. If any other guys have got a good understanding of where to find some equity markets, obviously you can use TradingView, and you can find access to those sites there on TradingView, which, you know, that is reliable. So let's just go to TradingView. So you'll get access to all the equity markets there. Just go to markets, go to indices. And then you've got, you know, loads of indices for you to choose from. That's dollar index, S&P 500. So let's just go to the S&P 500. And you can pull them up there. Okay, Mohammed. At least you know you can get them there from. But you can see there. Look, there's the. You can see how those equity markets are so sensitive to risk. You know, that's 5, 10, 15 minutes, and you've got that strong move from 2875 up to 2927 and beyond. So, you know. So next thing we do is look forward. Obviously, we're just looking at some Chinese data is likely to weigh on the Australian dollar. The big issue with China is global growth slowing, or is it picking up? Obviously, we've got that positive news of a meeting taking place now between US and China. So we're on a risk on sentiment, and obviously you have to read this Chinese data through that prism. But the optimism now that a deal is going to be struck is going to be higher. We've also got the pound CPI data. Now look, if we see CPI data falling, that's going to be negative for the pound, and it comes in line with Brexit sentiment. So that's the key issues, as well as the Euro preliminary GDP and Euro flash GDP going along with the rest of the sentiment we've spoken about with Europe. This was just one little quick learning point. We looked at this previous week for the RBNZ rate decision, and what we were saying is that, you know, if the RBNZ is more dovish, either downgrade future outlook, confirm more rate cuts needed in 2000 and introduce their thinking about Q, that'd be a strong New Zealand dollar sell. Now, as it happened, it was 0.1 came up, and in fact it was even more dovish than 0.1 suggested, which is the Reserve Bank of New Zealand cut interest rates by 50 basis points. Okay, so you know, I was there at my terminal when that happened, and this is the trade that I took. As soon as that happened, this is a 15-minute chart. I was slow getting in on the entry, and I sold a leverage position. As I said, I don't advocate using leverage, but when I get something like this, yeah, Mohammed, for live sites, use a site like forexlive.com. That's probably the best, forexlive.com. I do some work with those guys. They're a good bunch, so look at forexlive.com. And here's just a simple example. Now, I took profit there. That was a 4-hour pivot point. So I woke up 3 a.m., 3:15 a.m. my time, UK, saw the surprise interest rates, opened up the position, placed my stop above the highs before the announcement came out, and took my profit on the 4-hour chart at a key pivot point. You can see that was just a very key place. I then waited for a pullback, and then on the pullback, I took another short. I was looking for this trend line to be broken. So this trend line was broken. I took a short here. I was looking to take profit down the lows here. It didn't get that far on Friday, and there was a little bit of positive sentiment news that came out on Friday that just pushed the price high, and I thought I was only about like 2 or 3 points away from my take profit. Pushed it away, and I thought, okay, it's Friday, I'm just closing the position out. So I closed the position out, but that's just, that's the theory. Here's the practice. It's just having that conviction, and that's like, these are the kind of trades you want to wait for when you've got the high conviction. It's very obvious. The interest rates cut extra 25 basis points. Market wasn't expecting it at all, and then not getting greedy, but just taking your profit when you've got it. And then if you miss the first move, then just wait for that pullback. And I waited for that pullback, and there it was. Little intermarket correlation. The lower VIX, stocks rally, commodities rise, bond prices fall, bond yields rise, and risk on in FX trades. And the higher volatility index, stocks falling, commodities falling, bond prices rising, risk off. So here what we've seen is we've suddenly seen stocks rallying, commodities rising, and bond yields rise. And that's exactly what we're seeing, okay? So let me just show you that as we speak. And we've just seen that sentiment change while I've been here with you guys. So you have to forgive me if it's a little bit more, trying to process everything and to keep speaking at the same time can be a challenge. But this is a good. I'm glad I've shown you this. You can see, so the volatility index here, okay, it's now low. It's now minus 11.52%. Stocks rally. Okay, this was the trigger. Was this good news that US and China are going to meet? So we've seen a rally in stocks. S&P 500 up 1.59, S&P 500 futures up 1.38, Nasdaq up 2%, Dow Jones up 1.59%. Okay, strong rallying. We got the DAX up, we got the FTSE, Italian FTSE up, Spanish IBEX up, Euro stocks, CAC 40 moving up, FTSE 100 moving up. Okay, so then we'd also expect to see bond prices falling and bond yields rising. Here we see 10-year yields, 5-year yields, 2-year yields, all those yields up. So risk on. So we're expecting Australian dollar strength, Australian dollar strength, New Zealand dollar strength, and conversely, we'll see Japanese yen weakness and Swiss franc weakness. So that's the kind of very textbook play that happens. Now, your RBNZ central bank divergence, just wanted to show, yeah, here's a screenshot, you can just take that. So risk on markets, we see Australian dollar, New Zealand dollar, and CAD appreciate. Okay. So the central bank divergence between the RBA and the RBNZ. Now, this is interesting. What you've got is I'll just show you this across the chart because it makes sense seeing it across the chart. The RBNZ surprise markets cut interest rates by 50 basis points over the weekend. They were talking that they could have interest rates down to minus 0.35%. They're also considering potential of quantitative easing. Very bearish stuff. Okay. Whereas the RBA, they have been bearish, but as I've shown you, there's some potential reasons why the RBA, it might be a turning point. The Governor Lowe said that the Australian economy might be at a turning point. The Assistant Governor Kent last night was more optimistic. Business confidence was up a little bit. We got some labour data out that's key. So all of a sudden, I was looking at the two banks, and you're seeing that yes, they're both weak currencies, but the New Zealand dollar is weaker. And so what we've seen this bullish rejection. You see this key support level here at the 1.400 level. We've got support here, 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 and here. Okay, key support level. There's a bullish outside bar, right? Now that bullish outside bar is engulfing 1, 2, 3 previous candles off that support level. So, that's showing a potential for some upside, all right, technically and fundamentally. So what I'm looking for that divergence between the two central banks to continue. I'm looking for the RBA to be more optimistic and the RBNZ to be less optimistic. So if we see that divergence grow, I'm expecting that, that move up to, certainly up to the 200 exponential moving average, and if not up higher, up to the 1.100 level. Okay, so you could draw a trend line here. See, okay, that would look like a the support levels here, here, and here. So 1.0900 looks a potential target for potentially this trade if that divergence carries on. Now, this is a divergence that's developing. So it's not so strong as like, yeah, there's a definite massive divergence, but it's just something I'm beginning to see. So that's just one thing on my horizon, and I've put my stop just down below the lows here because that's the point where I'm going to know that I'm wrong, down at 1.0250 region. Okay, guys, with risk, we won't have time to go into the risk today, but obviously, be very careful with your risk. And I advocate not using leverage. So I advocate people using a trade size which matches their account size. So if your account is $10,000 US, only use one mini lot. That is a unleveraged trade. And as I said, is that I very rarely use leverage. But one time that I do use leverage, I used this week, as I showed you with that trade from last week on the New Zealand dollar. Guys, I hope that that's been helpful for you. It's been this tail on which side? Oh yeah, that table's. I'm with you. You're welcome. You're welcome, Aaron. It's been great. That table was on the Bloomberg terminal, and you can't get access to that, Sammy, I'm afraid, and I can't even give you access to it, even if I wanted to. I just wanted to show you that for the learning point. Okay, guys, thanks very much. I hope you have a really, really good week, and don't forget for the FX week ahead next Monday, and I hope to speak to you then. Take care now, guys. Goodbye.